Hi there and welcome from Ventura, California to today's webinar, New Car Reinvention, a roadmap for improved efficiency and profitability, sponsored by vAuto and hosted by WebAttract, the leaders in educational webinars. I'm Lori Dearman, Senior Webinar Producer with WebAttract, and I'll be your moderator for today's session. And in just a moment, we'll be introducing our featured presenter, as today's webinar is about hearing from him as he talks about strategies to reinvent your new vehicle operations to increase your sales, market share, and profits. You'll also have an opportunity to have your questions answered at the end of the presentation during the Ask the Expert panel session with our featured speaker today. Now, we've invited you along with a diverse audience from all across the country, and before today's event, we asked each of you to tell us a bit about what you'd like to learn, and many of you weighed in, so thank you for your input. And I think you'll find that our speaker will address the majority of the requests throughout today's program. At this time, it gives me a great pleasure to bring on our featured speaker for today, Brian Finkelmeyer. And now Brian Finkelmeyer serves as the Director of Business Development for Conquest at vAuto. And in this role, he's responsible for all aspects of vAuto's new car business. Prior to vAuto, Brian spent 18 years with Nissan North America in a variety of sales leadership positions. He is a frequent presenter and author for various automotive trade publications. His topics focus on helping dealers improve their new car operations. So Brian, it is an honor and a great pleasure to have you here with us today. Welcome to the webinar.
Thanks, Lori. Thanks for the kind introduction, and thanks to each of you for taking time out of your busy day to join this webinar. As I'm sure many of you are aware, these have been really challenging times in the new car business. I think many dealers I talk to express to me that they're feeling pressure from their factory in terms of their sales volume goals, CSI programs. You know, obviously margins have become increasingly difficult on the new car side of the business. And then we're also faced with record levels of inventory at many brands that I talk to. The manufacturers are producing more cars than ever, and so that's created another pressure. So all these things combined have certainly made it tough for each of you to kind of conduct your daily job and still be successful. But I've got some really good news. I think that we have some big untapped opportunities to become a lot more efficient in how we manage our new vehicle department. And I think if we're successful in improving our execution in some of these key areas, there's no doubt that we can make more money and sell more cars. You know, 2016 is just about behind us. It's hard to believe this year has gone by so fast. And I think this is just the perfect time of year to think about reinvention as we get ready for the upcoming year. You know, on the surface, the last couple of years, things have looked really, really good in the new car business. As I'm sure you guys are aware, the industry, total industry volume is around 17.5 million is what we finished 2015, and we're on pace for another 17.5 million or so this year. So on the surface, I think people are feeling pretty good as we came out of the recession. It's just been one record year after another. But as we take like a closer look underneath the hood of our new vehicle operations in particular, we find on a profit basis things are not quite as rosy. In 2015, the average dealer reported making just under $50,000 in net income, including F&I, based on NADA data. And what's probably even more concerning is that 33% of dealers reported having actually lost money in their new car operations in 2015. So despite, you know, record volumes of sales, you know, dealers are having some challenging times making money. And I guess I should say, you know, some of this probably there's some accounting in terms of how expenses are being allocated or how factory volumes are being booked. But I think we can all agree that no doubt it has become very challenging making money in the new car business. You know, I think there's really three key drivers of you know, the gross margin compression that we're experiencing, and the first of which, no doubt, is the pricing transparency that's now available in the market with websites like TrueCar and KBB. Customers are more informed than ever, and they have obviously very aggressive expectations when it comes to price. I think one of the other things that's been kind of going on in the background that maybe hasn't gotten as much attention as it deserves is just, you know, the record levels of production. If you look back in 2010, the new car industry had about 2.2 million cars on the lot, and today that number is up closer to 4 million. At last month, I think it was right around 3.8 million new cars. So, even though, as I showed on that first slide, sales have gone up by about 50% or so in the last 5 years, inventories have actually climbed even faster. Inventories are up about 75%. And so this is sort of another aspect that I think is leading to some margin compression. And then last but not least, and this doesn't apply to all brands, but many brands have increasingly turned to stair-step programs, volume-based programs to really stretch their dealers, dealers like you, quite frankly, to try to reach higher sales plateaus, which in metro markets in particular is creating some, hyper-competitive environments where, dealers are essentially competing with one another to see who will lose the most money per car. These realities have, quite frankly, sort of manifest themselves in the fact that we have focused more effort, in the last 5-6 years on growing our fixed operations, as well as, doing a better job in F&I. I think the average F&I income as of 2015 was close to $1,100 a car. And on this slide, you can see service contract penetration, just being sort of an indicator of that, has certainly climbed since 2005 significantly. And I think one of the questions that I sort of ask myself is, this is fine and great in the short term. We've kind of looked at other departments to sort of fill that hole of profit that we're no longer making in new cars. But sort of the question becomes, what happens if things begin to slow down? And I think as we look out at some of the headlines across the industry over the last few months, in particular this summer, there was growing concern that the auto industry had plateaued and that we were probably in line for, somewhat of a retraction, in 2017. Now, I don't think anybody believes this is going to be a significant retraction, but I think most auto analysts believe that the new car market has more or less plateaued and is probably headed for somewhat of a decline in 2017.
Now, Brian, I think this is interesting. Why do you think there is such pessimism about the U.S. auto market for 2017?
Yeah, that's a good question, Lori. I think there's a couple of issues. One of which is, this year, 2016, we're on pace for another 17.5 million, but there's a little bit of noise in that number, and the noise is that auto manufacturers have actually increased fleet volume. Fleet sales are up about 5-6%, while pure retail is actually down 1-2%. So we're already beginning to see a little softening of actual retail sales. I think the second issue that we're likely faced with here is the Fed is likely to increase interest rates in December, and I think that's going to probably slow down the economy a little bit in terms of purchases on cars and homes. And then lastly, I think this is a big trend that we need to be aware of, which is we are headed for enormous off-lease volumes coming back in the next couple of years. In fact, they're forecasting upwards of 4 million off-lease cars coming back in the market next year. I think that's going to put a lot of downward pressure on used values and what used cars are sold for, which will, as a consequence, will make it even more challenging on the new car side of the business. So I think that's something we definitely need to keep our eye on as we get ready for 2017.
So maybe now's a good time for a poll. What do you think?
Yeah, let's do it.
Yeah, so folks, I'm curious. You're all likely setting up your forecast for 2017. What kind of volume increase are you expecting to see next year at your dealership? Is it down versus 2016, flat to 2%, 3 to 5%, 6 to 9%, or 10% or more? All right, looks like 10% say down versus 2016, 37% saying flat 2%, 30% saying 3% to 5%, 7% of you saying 6 to 9, and 17% saying 10% or more. Brian, what are your thoughts on these results?
Yeah, it's interesting. I think the first thing that comes to mind is I appreciate the group there and the 10% or more, the eternal optimists that are, regardless of what the newspapers say, are looking to continue to grow their business, and there's probably something to be said for that sort of mindset. But I think the group there, the leading, group, sort of that flat to 2%, I think that's more or less where most of the economists and the industry analysts believe that the market is going to be. And I guess, we can't get too down and out even if the market pulls back even slightly, because let's face it, 17.5 million new car sales. is still about 2.5 million more than sort of the 10-year running average in the industry. So, I don't want to get too bummed out about the forecast for the upcoming year. I mean, the reality is we're still going to sell a heck of a lot of new cars in 2017. Well, great. Let's keep on moving. I think as we look out, to 2017, I think the key word that comes to my mind is we need to figure out how we become more efficient. Sort of that road to reinvention, I think, is going to take us, past efficiency. We've got to figure out how we become more efficient in our operations because, let's face it, there's no doubt customers have become a heck of a lot more efficient. And I think it's time, and there's plenty of opportunities for dealers to improve their efficiency. And I think there's really kind of three big opportunities, the first of which is just new car inventory management. The average dealer's probably got anywhere from $5 to $8 million of assets tied up in new vehicle inventory. This provides a huge opportunity for us to refine our process, and I think we can do a lot better job on the inventory side of things. I think, as we increasingly move into this digital age where consumers are moving more and more towards online transactions, there's a lot of opportunity for us to improve sort of the efficiency of the customer interaction with our dealerships. And then lastly, on the marketing side of things, NADA reported the average dealer is spending about $600 per car in marketing, which, when you look at some of these gross margins, I think last quarter the Toyota Camry, probably the number one selling sedan in America, the average gross margin on a Toyota Camry was $47. So, I think when you compare that to the $600 per car marketing investment, I think we need to become a lot more efficient on how we're investing our dollars and how we're executing our marketing plans. So let's start with inventory management. I met a dealer a few months ago in Pennsylvania and Philadelphia, and he commented to me that he had $1.5 million of inventory tied up in his used cars, and he had $13 million tied up in new. And what he said was, on my used car side of the business, I look at every single vehicle in inventory almost every single day. And there's a lot of precision involved in terms of how he's pricing, how he's merchandising. A lot of effort and energy goes into what vehicles they're bringing into inventory, how they're appraising cars. But on the new car side, he had 4 franchises, and he said, I got to tell you the truth, we just don't pay that close of attention to our new car inventory, nowhere near. And this sort of struck me, in this particular example, call it 8-9 times more investment with not nearly as much time or energy being placed in managing that $13 million. So I think the first kind of fundamental question that we have to ask ourselves on the new car side of the business is just this simple, what is our inventory turn? When I ask dealers, and I travel the country and talk to car dealers and ask them, hey, what are you turning your used cars at? More often than not, they can very quickly give me an answer. But when I ask that same exact question on new cars, I get a combination of blank stares, or I can tell the guy's trying to do the math in his head. And so what I kind of want to illustrate with this particular slide is this was actually looking at Hyundai across the nation, and I broke their dealer body up into 4 quartiles. So quartile 1 is the bar graph there on the far left. And what that's showing is that the very best dealers, or the top 25% of Hyundai dealers, are turning their new car inventory 5.9 times. And then down at the bottom there, the lowest quartile of dealers is turning only at 2.4. And I dropped in sort of the gross based on assuming that all things were equal, all dealers had 200 cars in their inventory. There's a significant amount, almost $1 million in gross variance between the top 25% and the bottom 25%. So that tells me there's some serious dollars involved in this. But I think the key question that we have to ask ourselves is, 1, what is my new vehicle inventory turn? And 2, how is my performance relative to other dealers within my brand? And I think that's one of the first things I'll show you from our Conquest new vehicle inventory solution that we've added to this tool is the ability to sort of monitor on an ongoing basis your inventory turn versus in this case, all Nissan dealers, or will allow you to benchmark yourself against the top 10% of performers to see, what your opportunity is. And we'll also allow you to drill down not just at the full inventory level, but will also allow you to drill down and look at each unique model within your lineup. So this is just one of the aspects that we've brought to the tool to try to bring more visibility to that very important metric.
Now, Brian, you mentioned that a lot of dealers don't pay close attention to their new car inventory or their inventory turn. Why do you think that is?
Yeah, I think historically, Lori, there's a couple issues. One of which is, many dealers I talk to tell me that they don't really view their new car inventory as a depreciating asset. Meanwhile, on the used car side of things, I think they absolutely do. So there's a heightened sense of urgency on the turn issue on the used car side. But on the new car side, because they're not depreciating quite as, the depreciation not quite as pronounced, I guess, dealers have not been historically quite as focused. And then I think the other thing is just sort of a mindset on floor plan credits, right? So, most of you on the phone are receiving floor plan credits on a monthly basis, and sort of this stream of revenue from the manufacturer sort of serves as an offset to your monthly financing charge from your holding cost. And I think, the smart dealers out there are beginning to say, hey, with margins being as compressed as they are, I've got to find more opportunities to create profit streams. And one of those, very evident profit opportunities is being more efficient in my floor plan. And I saw, last year, AutoNation reported about $65 million in net income, strictly based on floor plan profit. So that tells me that many of the public companies, that are beholden to their shareholders are absolutely looking at floor plan as a revenue opportunity. So let's talk a little bit about, some tactics that we can deploy to manage our inventory more efficiently. And I think the first thing really just comes back to ordering. For most brands I talk to, we sort of get a monthly allocation or a mid-month allocation where we're being faced with, a whole litany of choices. And what I've found out from a survey that we did not too long ago was that the average dealer told us that they only spend about 2 to 3 hours per month on this very important activity. And so, I think we have to be very, very careful in how we proceed with that monthly activity, because the manufacturers at most brands make it very, very complicated in terms of all the different orderable combinations that you have available to order. And this was just looking at the Infiniti Q50. There's 2,900 different combinations of Q50 currently in dealer inventory. And it was striking when I saw that 1,850 of those combinations had one or less sales in the past 90 days, which tells me if you just do the simple math, there's about a 65% chance of sort of ordering the wrong car. So I think we need to be a lot more precise and thoughtful when we're doing that monthly activity of working our allocation with our OEM partners. And then the second thing that I really wanted to kind of bring to your attention is I was thinking about this recently. This is no doubt very challenging stuff. And historically, I think dealers have more or less relied upon, recent sales history, and then let's just be honest, gut feel and intuition and sort of those types of things come into how we order our cars. And I guess I think most of us would agree that when we're ordering cars, there's a couple other considerations that certainly should be factored into our thinking, one of which is market day supply. A few months ago, I looked in Washington, D.C., there were 1,500 Toyota Camrys, LE trim in Washington, D.C., and 400 of them were silver. So the market day supply of that car was like, over 100. So it'd be like, I'd be very reluctant to say I need to go order a lot more silver Camrys. And then I think the other element that we need to look at is sort of this days to sell. How quickly do we expect those cars to turn? Because that's clearly what we're driving for. So I don't know necessarily if my weighting, I'm not a mathematician or a statistician, but what I did was I kind of weighted these three important variables as a third to kind of create a new index of ordering desirability. And when I applied that to the Nissan Altima, it was sort of interesting what I uncovered. The first row there, sales rank, just basically ranked every model, trim, and color combination based on just pure volume. And what stands out there is that the black on black 2.5 SV actually ranks 11th in terms of sales volume. And then the next column over, I ranked every single car based on their market day supply. And you can see on market day supply, this car does much, much worse. It has a rank of 51. And then we applied the days to sell kind of filter against this. It came out at 40. And so its kind of overall desirability was 23. And then when we look at a car just two cars away, the blue 2.5S, with a sales rank of 13, I think what really sticks out here is it actually ranks 4th in terms of velocity, and it had an overall desirability of 6. And so I think if we kind of took more of this information into account as we're doing that monthly ordering task, we would be much more likely to stock the black 2.5S than the normal black on black if we just kind of strictly went more based on retail sales history. You know, one of the really neat things that we do within our Conquest tool is we provide our dealer clients with very granular level of information to help them make smarter stocking decisions. And there's a couple things I want to point out on this slide. This is looking at a Hyundai dealer out in Orange County, California. What's particularly interesting to me is that the 2016 Hyundai Sonata Sport in silver had 142 market day supply in Orange County. And then if you looked at the exact same vehicle, just different color, the white, was a 13 market day supply. And so my question, I've showed this to a lot of dealers, is how many dealers actually realized that the silver Sonata Sport had a almost 10 times higher market availability than the white. And I think if we had these types of insights readily available to us, it's going to help us in a couple of ways. One of which is we're going to make a lot smarter dealer trade decisions. So when the dealer calls me asking me for my white Sonata Sport and offers up the silver on the trade, I'm certainly going to be reluctant to do that. However, you know, one of the things we talk to our dealers about all the time is, you know, we can go on offense and we can use this information to help make our month go a heck of a lot easier. If I understand that I'm heavy on silvers, I'm short on whites, we should be out actively, proactively trying to dealer trade in those vehicles into our stock. You know, one of the other things that we talk to our dealers about doing is adjusting price with age. You know, we certainly do that on the used car side of the business. Oftentimes I'll see a dealer whose car that's 300 days old and then the identical same exact car is only 3 days old, just showed up off the carrier truck, and we've got the two cars priced identically. I mean, I think we have, you know, we've come to a point in time where we have to be more sophisticated than that. And so that's one of the other really neat aspects of the Conquest tool is we allow you to understand at a very granular level. In this case, looking at the 2017 Ford Fusion, you can see there this car has been in inventory for 186 days. And I'm priced at 117% of market. You know, I was priced here at $37,000, and you can see we allow you to have this, you know, 360-degree market visibility to how all of your key competitors are pricing. And in this particular example, 9 of my 10 competitors are priced more competitively than I am, which is probably a recipe for me keeping this car in stock longer. So that's one of the things that we try to do is help our dealers both manage price from an aging perspective as well as from sort of availability. You know, one of the other ideas that I'd like to propose today that I really think that dealer principals should consider is most pay plans, and this is, I'm probably, you know, walking on thin ice here by bringing this up to a lot of new car sales managers, but I have to be honest, you know, most sales plans that I've seen over the years pretty much revolve around volume and gross, and then maybe a percentage of the volume bonus money you make from the factory, what have you. But if I was running a dealership, I think I would certainly give thought to adding a component to pay plans on inventory turn, because I want to make sure that if there are ordering decisions that are, you know, made in error, that there is sort of a financial consequence to that. I want to make sure that my sales managers and desk managers are appropriately managing the lot, and that that 300-day-old car isn't parked behind the parts department. And I also want to try to figure out a way, as I mentioned before, of how we can turn that floor plan revenue source into a profit maker and not just sort of an offset for our monthly floor plan charge from our captive finance arms. You know, let's take a look at what a 10% inventory improvement, inventory turn improvement would look like. You know, I said here if a dealer in 2016 had 200 cars in stock, let's assume that 2017 we continue to stock 200. You know, an annual improvement of just 0.4, 10%, yields us, you know, an additional 80 cars, which is really only about 6 cars a month. So not significant in the big grand scheme of things, but boy, it has a significant impact on the bottom line. If I'm averaging 1250, which I think is a reasonable level of gross, including F&I, you know, it's an additional $1 million in gross potential. Not to mention, you know, what I'm going to pick up in additional floor plan, advertising credits, dock fees, factory bonuses. And, you know, the new car game, whether we like it or not, is really sort of this domino effect. And as I sell more new cars, I create all these other downstream revenue opportunities. So I think having that real focus on, hey, what can I do to improve my inventory turn by 10% for the upcoming year as a goal, you know, certainly could pay huge, huge dividends from a financial perspective.
Now, Brian, if I could jump in here a second. Um, Earlier in the presentation, you mentioned the likelihood for a flat market. Is it reasonable to think a dealer could improve turn 10% in 2017?
Yeah, well, I mean, I guess I'll first say that there were 17% of the people on the poll that already think that they can improve their turn by 10%, so that's great news. But I absolutely think that all of us on this call have an opportunity to improve by 10% just by paying closer attention to what we're stocking, as I kind of talked about earlier. You know, today's internet shopper is really out looking for a couple things, but the first of which is they're trying to find the right car. And so if I do a better job of stocking those more desirable combinations and being more precise in how I'm ordering and how I'm conducting my dealer trades, I absolutely think I can pick up 6 additional sales a month to drive, you know, a 10% improvement in terms of my annual inventory turn. But it's going to require a lot more than 2 to 3 hours a month in terms of time investment and what we're looking at in terms of the analysis required to find those opportunities that the market presents. So let's move on to customer experience. There's a lot of work in the industry being done on this right now. And I think, you know, when we think about online retailing, there's probably no better example than what Amazon has achieved. And this was a great quote from Jeff Bezos, the CEO over there. And he said, you know, we're not competitor obsessed, we're customer obsessed. We start with what the customer needs and we work backwards. And so I think if we think about the car market and how that applies, you know, what does today's customer want? I think it's very obvious what they want. They're looking for speed and they're looking for transparency. And so I think we need to think about our operations in terms of, just like Jeff Bezos said, we got to start with what the customer wants and kind of work backwards. And so I want to talk about a couple of things, one of which is, you know, it's sort of an unfortunate truth, and I almost feel bad saying this, but you know, dealers across the country have invested millions and millions of dollars into beautiful facilities, just like this Mercedes store out in Scottsdale, Arizona. But the sad reality is that today's customer really doesn't want to spend a lot of time in the showroom. They want to spend a lot of time on your website. And it's so much more important that we spend more time optimizing and making sure that our website is providing what the customers want, because that's the conduit to getting that customer to come and pay me a visit. You know, looking at that particular Mercedes store, there's a great quote that I heard years ago that said, the more you tell, the more you sell. And this particular store that I just showed, in Mercedes-Benz of Scottsdale, you know, they are restricted, I believe, by Mercedes in terms of pricing, but they do provide a number of buying tools to sort of help that customer with trade-in appraisal questions, with financing issues. There's an opportunity to set test drive. So they're doing many things for the customer to allow them to bring more and more of that sales process, quite frankly, to their couch. And then one of the other great examples that I've used before is the Del Grande Auto Group. They have been, you know, sort of pioneers in terms of leading the charge in terms of market pricing transparency. And one of the things that they've embedded now on each of their landing pages is the KBB Price Advisor, to sort of substantiate to the customer who's doing his online research that, yes, I'm giving you a very fair price. In fact, I'm maybe even a couple $100 below KBB fair market value. And one of the interesting takeaways from this project that the Del Grande Auto Group did with KBB was they actually saw that their grosses went up about $200 to $300 a car just by being more transparent. So I think there's really something to be said there, that, you know, customers are willing to maybe even pay a little bit more if we're more transparent up front. You know, one other thing I think we really, you know, need to rethink is sort of our BDC department, which really, if you think about it, is really becoming sort of it should become the internet concierge department, because our internet shoppers, you know, this is when they have questions, whether they go to a chat function or click to call type functionality. You know, unfortunately, I think many dealers are sort of outsourcing that activity to third-party companies, and the result of that is that we basically, our BDCs, their focus, their pay plans, everything revolves around getting the appointment. And I think today's internet shopper is not so interested in about, hey, what time am I going to come and visit you? They're calling you because they've got a question about a particular vehicle, they've got a question about a price. They're looking for information, and the better job that we do in terms of being transparent and providing that information is only going to lead to a much higher percent chance that we'll actually land that appointment. Excuse me. A few weeks ago I spoke with a close friend of mine who was telling me that he was speaking with a BDC department, and the BDC manager kept coming back to, well, how soon can you come down here? How soon can you come down to the store? And his response was, why do I have to come to the store? We're having this conversation right now. I think his thought was, I just want to go to the store to pick up the car. That's all I really want to do once I get to the dealership. And I know that's probably painful to hear, but I think increasingly that's kind of where the customers are moving. We win customers with speed. This slide pretty much tells the story. Any sales transaction that lasts longer than 90 minutes, you can see there's a pretty significant drop-off in terms of the customer satisfaction. So this once again speaks to, bringing those shopping tools, trade and appraisal, these key things that take a lot of time at the dealership. As we bring more of that to an online environment, we can make the sales process a lot more efficient. And I think ultimately customers, when they're out there shopping for cars, they're looking for the right car, the right price, and the dealer that's going to provide them with the most efficient sales experience. And I think this slide sort of bears that out.
Might be interesting to get the audience's take on this. So folks, got a quick poll coming your way. Would like to hear, what is the average amount of time it takes for customers to complete new vehicle purchases at your dealership? Less than an hour, hour to 2, 2 to 3, 3 to 4, 4 plus. Okay, so no one doing it in under an hour, but we've got our front runner there with 46% between an hour to 2, 31% 2 to 3, 15% saying 3 to 4, and 8% of us saying more than 4 hours. Brian, how does this stack up?
Yeah, I think that clearly demonstrates to me that we've got a lot of progressive dealers on the call today that are obviously focused on this. If almost half of the sales transactions are happening in 1 to 2 hours, I think that is, that's fantastic. My sense is that that's probably not the case across the 17,500 dealerships in America, but clearly those of you that are on the call today are doing a very good job in that regard. So let's move on to my last section here and talk a little bit about marketing. I sort of touched on this a little bit before about the online shopper, but they say that today's shopper is actually only physically visiting 1.6 dealerships. And this does sort of bear itself out for those of you that are in showrooms every day. I've been in the car business for a long time, and it's noticeable to me when I go into car dealerships that there's just less people in the showrooms than what I recall. And I think a lot of that just speaks to these themes that I've been touching on about customers wanting to bring more and more of that shopping experience to their computer, and the dealership, quite frankly, is sort of becoming a delivery center. And one of the jokes that we kind of say is that the 0.6 and this 1.6 is probably just the dealership that messed up the sales process. The fact that the customer came and paid you a visit clearly demonstrates that you had won the game online, but probably fell down in terms of your sales process once the customer got there. So no doubt the game is being won and lost online, and I think there's really two key marketing challenges, and it's tough, that dealers are faced with, one of which is just, what's the appropriate allocation of my monthly marketing budget? That's one issue we have to think about. And then the second issue is execution, and I think there's actually quite a few examples I can share with you about how we can improve our execution. So first, let's talk about, are we investing our dollars correctly? Last year, NADA said that the average dealer was spending about $500,000 a year in their total marketing expense. As I mentioned earlier, that breaks out to about $600 a car. And then when you kind of look and see where customers are spending their time and their shopping, dealership websites, OEM websites, search engine, third-party review sites, all of these sky-high, very high frequency rate, yet only about 25% of the dealer's marketing budget right now on average is being applied to digital. Meanwhile, we're kind of stuck in the way we used to do things. The bulk of our budget tends to be focused on the traditional advertising mediums like television, newspaper, and radio, which you can see customers are increasingly less likely to consume, as we are really in an extraordinarily fragmented media environment with XM radio, your iPhone hooked up to your car, or Netflix, and all the different opportunities in terms to not watch commercials, quite frankly, with the DVR. I think it really needs to be a jolt for us to kind of rethink how we're allocating our marketing dollars. And this is kind of an interesting slide. which is sort of, I think, very, very telling, which is when you kind of look at these four quadrants here in terms of trustworthiness as well as helpfulness, the bottom left-hand quadrant of least helpful, least trustworthy is exactly where the 75% of our dollars on average are going, which is, advertising on TV, advertising in the mail, advertising on the radio. It says here shoppers just don't find this advertising very helpful or trustworthy. But I think dealers tend to, allocate that way, partly maybe just out of comfort. That's the way we've done it for a long time. And quite frankly, digital, there's a lot of confusion to this in terms of SEO, SEM. How's the right way to do this? I've got vendors coming into my store every day. I'm not sure what the right mix is or what the right thing is to do. But I think no doubt we have to crack that code moving forward to start whittling away at that $600 per car ad expense. Digital provides us with a much more efficient opportunities. And so I think if I was running a car dealership, I'd certainly want to make sure that I had meaningful advertisements, in terms of search engine, independent review sites, even, local newspapers provide better engagement, I think, with shoppers than some of the conventional things. And then the last thing that I sort of highlighted here, that I think presents a real opportunity for us is, dealership websites, customers view them as helpful but not very trustworthy. And so I think that kind of goes back to what I was talking about before. The more we can do in terms of providing market transparency on price, the KBB price advisor wheel like the Del Grand Auto Group did, or including more of these shopping tools so that the customer can get a sense of what their trade-in value is before they come to the dealership, we can begin to sort of move that dealership website up into that upper right-hand quadrant.
So, Brian, just from your perspective, what do you think is the appropriate mix between digital and traditional media?
Yeah, it's a good question, Lori. I think it probably varies by market, but I think definitely, it definitely needs to be north of 50%. And I think, quite frankly, probably, to be perfectly honest with you, if I was running a store, it would probably be closer to 80% plus. This is definitely, if you look at where shoppers are spending their time, they say the average shopper is spending roughly 15 hours of research before they make a car buying decision, and the vast majority of that time is being spent online. So I'd want to make sure that I was presenting myself as the most trustworthy, most helpful dealership. And I think oftentimes, we sort of, look at the guy's facility down the street, or we compare some of these more tangible things. But I think today's dealer needs to sort of take a look and say, how good is my website relative to all my competitors? Are my competitors providing more transparency in terms of price? Are my competitors providing better photos, better descriptions, these types of things? I think we need to do a closer look in terms of keeping track, and I would set my goal to be, do I have the most compelling, customer-friendly website, in my marketplace? So let's talk a little bit about the execution on digital, which, I visited a dealership down outside of Atlanta a couple weeks ago, and he was spending $7,500 a month on Auto Trader, $5,500 a month on Cars.com. And I kind of said to him, I said, is this part of the strategy that we're going to drive traffic to your store, with full MSRP pricing? And his response was, well, there's some sort of a mistake here, and that this is not pulling from my website correctly, or that there was some issue. We went to his website, and it turned out that all of his cars were at full sticker on his website as well. And so, I think the one key stat that I'll share with you there is that customers are about 180% less likely to click on cars at MSRP. So if we're going to make, in this case, $13,000 monthly investment to promote our inventory online, I think it certainly makes sense to provide, some sort of a price that's something other than full sticker. One of the other opportunities that I think sometimes gets overlooked is in terms of vehicle descriptions. On the used car side of the business, we do a really good job of making sure that we fine-tune the exact description of what the mileage is, the condition of the car, what equipment's on the car. All that stuff's very important because we recognize that that's what customers are searching for when they go onto websites like Auto Trader. But this year's sort of an example. I just did this search. I live in Nashville, and I looked for a 2016 Ford sedan with navigation up to $28,000. And you can see the search result on AutoTrader was just that, sorry, we couldn't find your dream car. Well, I know, and you all know, that that car certainly exists within a 25-mile radius of Nashville, but the reason why that car's not coming up is because it hasn't been described properly, and so it's not being picked up in the search results. This is one of the great aspects, quite frankly, of vAuto Conquest, is we provide a really good listings management tool that allow you to describe all your cars correctly, as well as provide nice written descriptions, which can certainly differentiate your listings against other dealers in the marketplace. And it's certainly going to have a big impact on helping you come up more frequently in those search results, like that Ford example I just shared. So, no doubt, I know I've thrown a lot at you today, but reinvention's never easy, and I think it does start with sort of a couple first steps, and there's no doubt if you want to try to improve, you have to measure what you manage. And there's a couple key metrics that I would ask you to go back and look at within your dealership, the first of which is, what is your inventory turn and how does that compare to other dealers within your market, within the same brand, obviously. 6 is just sort of a guide rail. There's brands out there right now like Subaru that their average turn is 12, so the 6 wouldn't make sense for Subaru. But I think for most of the big brands, your Chevrolets, your Fords, your Toyotas, your Hondas, if you're turning your inventory at 6 times, you're doing a pretty good job. And certainly that's something that we should be benchmarking and setting a target for ourselves for the upcoming year. If we all believe that customers are only visiting 1.6 dealerships, there's absolutely no reason that my true closing ratio on showroom traffic should be north of 70%. And like I said, those deals we're losing are likely because we had a breakdown in our sales process at the dealership. And then the last metric that I think we should really pay close attention to as we move forward here is just this advertising per car. And as we're being more efficient with our advertising mix and kind of fine-tuning our digital footprint in our market, I don't see any reason why we can't get closer to $200 to $300 a car. In fact, many of our clients are already a lot closer to $200 than $600, and that can yield a lot of additional profit for the dealership at the end of the year just by being more efficient with our marketing spend. So let's talk a little bit about some potential next steps. At vAuto, we obviously have going on 11 years track record of helping dealers improve their used car inventory turn, and we're trying to do many of the same things on the new car side of the business. And so I'd certainly encourage you to go out and visit our website, vauto.com. We've got a new car report that will give you an opportunity to help us take a look at your dealership's new car inventory, and we can tell you very clearly how well you're turning your inventory relative to sort of the brand benchmark, as well as take a look at your aged inventory and how fast your various buckets of cars are turning. So this is something we'd love to partner with you if you're interested in learning more about how we can help you grow your new car volume for the upcoming year. So with that, Lori, I think I'll turn it back over to you.
All right, thanks so much, Brian. And folks, if you do have any questions, it's certainly not too late to go ahead and put those questions into the queue, and we're going to start lining them up for Brian to address. So I'm going to start with this first question here coming from Scott, and that is, what if my OEM doesn't give me pricing flexibility online?
Yeah, that is a common issue that we face. Some brands have been strictly restricted to MSRP, like Mercedes-Benz example that I shared there with you. But increasingly, more and more brands, in fact, Lexus over the summer, they had for 25 years only allowed their dealers to price at MSRP, and now they've made a change to that policy. And I think increasingly there's sort of this realization in the industry that customers are looking for pricing transparency. Customers are obviously shopping on TrueCar and KBB, and there's sort of a disconnect if we just list all of our inventory at full sticker. So I think it seems like kind of the landing place where we're at right now with most brands is that they will allow you to price somewhere between invoice less rebate, all the way up to MSRP. So there's probably on most cars somewhere in the ballpark of 15% range or spread there that does give us some degree of flexibility in how we price our new cars. And I would encourage you to use that range appropriately as we think about high market day supply cars, as well as some of those aged examples that I shared earlier.
All right, let's see here. We've got a question from Susan, and that is, what if everybody followed this roadmap? Wouldn't that be a race to the bottom?
Yeah, it's a good question, Susan. I think at the end of the day, it's all going to come down to execution. And tools like vAuto, I mean, we've got over 8,500 customers in the United States, and there's obviously varying degrees of execution within that customer base. And so I think that at the end of the day, the customers that are engaged the most and paying the closest attention are the ones that are going to yield the greatest results. And I hear that often, that that this is all about a race to the bottom. And I got to tell you, there's many times where we're sort of in this mindset that we have to give everything away, when the reality is there's been numerous examples I've seen where a dealer is the only dealer in the market to have a particular model, trim, color combination. The market day supply on that particular vehicle is very low. And then you go out to these third-party websites like KBB and TrueCar, and they're saying that this car's fair market value is $21,000. And I've seen examples where the dealer had the car listed for $19,500. So sometimes I think we're overly aggressive unnecessarily, and that's one of the aspects of our tool, where we try to help dealers understand where those opportunities are, where they can actually make a little extra margin. In fact, one of our biggest clients out on the East Coast in Washington, D.C., he told me that's where he sees the real value in this tool, is helping him see the market landscape and helping him identify vehicles where he can take a little additional gross profit.
All right, we have Rick here asking, what is a reasonable level of aged inventory?
That's a good question as well. I think most floor plan credits run out at 60 to 90 days. So I think that dealers really sort of need to try to begin managing their inventory closer to, I want to mitigate as much possible of cars that are older than 180 days. I think is really kind of the danger zone once they're getting past 6 months. And we have examples of clients that are absolutely doing that. But I think dealers, at that 60 to 90 day mark, if this car has not sold, I think that needs to be a trigger to say, hey, this car either needs a pricing change, I got to go back and look at how I've merchandised this car, maybe I can improve my description of the car, let's go out and do an audit of what this car looks like on AutoTrader or Cars.com to see, is there some other reason that I can glean why this car is not getting more activity. But yeah, I would say that in my mind that that 90-day benchmark is where we really need to start honing in closer and refining why, understanding why this car is not turning.
All right, another question here for you. What if my manufacturer doesn't provide much ordering flexibility?
Yeah, that's a tough one. Most brands that I have engaged with, they do allow the dealer a certain degree of manufacturing flexibility, but it obviously varies. At Ford, I know at the end of the model year they will certainly restrict dealers in terms of what crew cab, what bed sizes they can get, or whether it's a crew cab or a king cab truck. And so I think you just have to kind of make the best hand that you can with the cards that you're dealt. There's many brands that are providing an enormous amount of flexibility, and that example I shared earlier on the Infiniti Q50, there's almost so much flexibility that there's a lot of opportunities to make mistakes. So I guess my answer to that question would be, for those of you that are working at a dealership that does provide ordering flexibility, let's make sure that we're making smart decisions and not making mistakes. And for those of you that don't have as much, I mean, I can say nothing more than you just have to make the best hand that you're dealt. And I think you can still use, market level insights to make smarter dealer trades as an opportunity to enhance your inventory, that route if you can't get it directly from the factory.
All right, it looks like gotten through our questions here in the queue. Wondering, Brian, if you have any comments you would like to leave our audience with.
Yeah, I mean, I think first off, just thanks again for taking time out of your day. I hope I pointed you towards a couple of opportunities or things to look at or think about differently. And I think, as the market, as we said, is likely to probably be soft, maybe flat in the upcoming year, but let's not get discouraged. It's still a 17.5 million unit industry. There's tons of opportunity to be successful, and I think dealers that increasingly do a better job of managing that new vehicle inventory, provide customers with a more efficient buying process, and are smarter about how they're allocating their marketing budgets, have huge opportunity for increasing their profits for the year ahead.
All right. Well, I thank you so much, Brian. And folks, before we sign off, I would like to thank each of you for joining us and trust that you found today to be of value. This is Lori Dearman saying have a great rest of the week. Bye for now.